Welcome to another monthly Big Picture episode of the Michael Yardney podcast. If you're a regular listener, you'd know that each month I get together with leading financial commentator Pete Wargent, who brings decades of perspective to his views on what's ahead for the economy and property. Clearly, our property markets don't work in isolation, so we talk about the big picture, the macroeconomic factors, but we're going to dig into some detail today as well. We're going to discuss what's really ahead for inflation and interest rates, and what this means for our housing markets. Are we heading for a recession or maybe even stagflation? We'll talk about the latest finance figures, which give us an indication of what's ahead for our housing markets, plus much more. So by the end of today's show, I hope you're going to have a bit more clarity with all the mixed messages in the media. So let's get on with my chat with Pete.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Well, Pete, good morning. I always enjoy our Big Picture podcasts, and since we last spoke, I've been following your daily musings, your blogs, and seeing you on social media, and you seem to be travelling around the world. Where are you at the moment?
I'm in United Kingdom this week. I've just been in Greece over the European summer, but yeah, I'm just heading to the US for a week or two, Boston, then LA, and then back to Australia. So doing a round the world trip with one of the Aussie airlines this year, and it's been pretty good.
Fantastic. Okay, well, I know that you've had your latest book released a little while ago, and I'd like to have a chat about that a bit later on so people can find out more about it. But let's have a look at what's happened since we last spoke about a month ago. Now, it's a little bit of old news, but I think it's still worth discussing that a little while ago, the Reserve Bank Governor, Michelle Bullock, made a massive call that sent at the time the media, government and communities in a spin. Speaking at a fundraising lunch, Governor Michelle Bullock acknowledged the bleak reality of households struggling in Australia because of high interest rates. And she conceded that some people, and her quote was, may have to make the difficult decision to sell their homes. Well, you can imagine the media had a field day at that, Pete. What are your thoughts about what she said and why?
Well, there's no way the Reserve Bank is going to be doing anything other than jawboning at this point, because the inflation rate in Australia is still above the 2 to 3% target. So until we get back to target, they're going to be talking tough, I guess. But there's been some really promising signs for inflation, even since we last spoke. So I think if you look at the ABS figures, the most timely monthly index fell from 3.8% back to 3.5% in July. And actually, when you dig into the numbers, a lot of those electricity bill subsidies don't actually hit until August. So next month will be lower again. And with the base effect, we'll be heading down to 3% and below. There's other measures as well. If you look at inflation, which is the Reserve Bank's main concern, and the Melbourne Institute has a gauge which fell all the way back to 2.2% on the trimmed mean measure. So, I mean, normally what happens is the ABS figures follow what happens with the Melbourne Institute. So if you take that at face value, we're heading back to target. But of course, the Reserve Bank's going to keep talking tough. I think the other thing that's happened, even since we spoke a month ago, is that oil prices have suddenly really tumbled. And for Australia too, iron ore prices are now down below $90 a tonne. Coal prices have collapsed. So if you look at our government bond yield for the 3-year bond, it's under 3.5%. We just haven't seen anything like that over the past year. And we're starting to see, well, we will start to see, for example, 3-year fixed rates falling to 5.5% and below. And if you just look at market pricing, forgetting what the Reserve Bank says, well, interest rates probably heading to about 3.2% 18 months out. So that sort of implies 4 or 5 rate cuts potentially.
Yes. Well, inflation is coming down, maybe not as fast as what the Reserve Bank would like, but when you look at what's driving it at the moment and what's still making our economy keep ticking over. There is jobs. The Albanese government's funded 2/3 of the jobs recently. So the government spending, government infrastructure has been a major driver of inflation. They're putting more money into the system, into aged care, childcare, higher education and health. I guess that's going to keep coming, being an election year. There's going to be all these promises of more spending, Pete.
Well, that's right. It's what Tarek Brooker refers to as burnout economics. The Reserve Bank's trying to slow the private sector of the economy, but the government's been spending up pretty big, high population growth as well, a lot of spending on infrastructure, and that's sort of kept some pressure on particularly construction costs. And I think actually, if you look at how this is manifesting itself in inflation, well, building cost inflation has been very high, as you guys would know better than anyone over the past 4 years. But that does seem to be coming down. And I think also rents has been a big part of the inflation story. But again, rents seem to be cooling in real time. I think one of the interesting things from the latest ABS figures, I mean, these are sort of estimates, but if you look at the number of dwellings, about 11.2 million or so. So it looks like the number of people per dwelling is on the way back up now. So in other words, Aussies are bunching up again, probably as more employers call employees back into the office and some people are getting back to normal. So I think that's just taking some of the pressure off home building inflation, some of the pressure off rents as well. So that's actually now starting to help as well.
Well, I think Michelle Bullock's comments were in response to Treasurer Jim Chalmers' comments earlier in that week when they were made. Jim Chalmers, it was before the GDP figures, which were showing how our economy is going. I think he tried to get in advance and say, hey, it's the Reserve Bank's fault, not mine. He said the Reserve Bank's 13 interest rate cuts are hammering the economy. I mean, I remember it wasn't that long ago that the headlines were filled with predictions of an imminent recession for Australia, and that was the concern, that our GDP wouldn't be growing. Now, it sort of made sense. Higher interest rates, well, they're meant to stall the economy, they're meant to increase unemployment. So it sort of made sense at the time, but it really hasn't happened, has it, Pete? We haven't fallen into a technical recession, even though clearly we've got a per capita recession.
Well, that's right. I think if you look at it on a headline basis, GDP has sort of been going up just a little bit, 0.2%. But as you said, per capita we're sort of going backwards. So if you look over 2024 financial year, GDP increased by about 1%. But don't forget, we've had population growth of about 2.5%. So if you look at it on a per capita basis, we've really gone backwards by around 1.5%. I think if you look at things like household consumption, well, that's been really, really slow now for 18 months. So it would feel like a recession for some households. Prices have increased faster than incomes for a lot of households. And it's only, I suppose, been that public spending and infrastructure investment that's kept headline GDP positive. I think the thing for households is, if you look at the last 2 quarters, the household saving ratio, which during the pandemic ballooned to over 20%, well, it's basically nothing now, 0.6% in March, and the same again in June. And I think if you take into account things like superannuation contributions, for a lot of households now, that's probably negative. So those pandemic savings for a lot of households are now being depleted.
Sure. So that means that people who've used up their savings buffer are now starting to feel the pinch. Now, Michelle Bullock said people are going to sell their homes. She suggested it was going to be the poorer Australians, the lower socioeconomic group that would be in that 5% of Australians who could be in the position to do it. But if we look back at previous times, there's always been the talk about mortgagee sales. I don't know, there was the fixed interest rate cliff and all the other cliffs that didn't occur. Australians would rather eat Maggi noodles than sell up their homes, and banks don't particularly want people to. If they do sell up, where are they going to go? There's no rental accommodation either, is there?
Well, funnily enough, S&P Global Ratings put out their mortgage arrears figures every month, and they actually went down last month for prime mortgages. So, yes, there's definitely a bit of stress around for some households, but generally speaking, with the unemployment rate under 4.5%, there's a job for pretty much everyone who's looking for one. Rents have gone up for some landlords. And I think as well, the fact that the finish line is in sight and potentially interest rates are coming back down will encourage the households who are under stress to either maybe try a refinance or just to cling on. some investors are selling up as well. I think we've seen in Melbourne, if you look at the ratio of landlords on the listings, it's probably about 40%. So some investors have taken the opportunity to sell up and just rejig things a little bit. But generally speaking, arrears have stayed under control.
Sure. Well, just to clarify things, we talked a bit about a per capita recession. For those who don't understand, it's when the GDP, which is the measure of how Australia's economy is going, all the services and goods that occur, while they're not going up per person. And in fact, we've had 6 consecutive quarters of falling GDP per capita. So, yes, there's no doubt that some households are suffering. And as you say, the end looks like it's in sight. We've got to go through that. So why didn't we have the recession? I was thinking about it, Pete. I mean, we did have, up until recently, very strong exports. So that supported our economy. We've already said the government's been spending a lot. You've already mentioned the household savings buffer got through people a lot, but the labour market's also been strong. We've created more jobs over the last year or two, despite all these challenges, than we have for a long, long time.
A lot of the jobs have been created in the public sector. So it
Yes.
goes back to the point you made on government spending, and things like the NDIS and healthcare hiring has been really big. And I think the flip side to that is that productivity in Australia has been struggling quite a lot. And I think some of that is probably related to the slow return to the office as well. And some of the sort of income measures in the economy have been faring a bit badly of late as commodity prices have come down. So I think there's a positive aspect to all this. I think, yeah, we've seen high population growth. There's been quite a lot of inflation, but I think a lot of that now is in the rear view mirror. And there's a few things on the plus side. Boomers are doing well, so it's good for them because they generally don't have as much mortgage debt. Superannuation and the stock market have been very, very buoyant. I think yourself and Simon Kustenmacher have talked about there's an enormous intergenerational wealth transfer to come of 5 or 6 trillion over the years ahead. And also, I think if you look at things like petrol prices, well, they should really tumble from here if you look at what's happened to the price of oil. So, yeah, we're in a bit of a sticky patch at the moment, but there's lots of reasons why things might start to pick up over the next year or two.
Well, the news loves giving us scary headlines. We know the media's job isn't to educate us, but to get us to click on the headlines because they've already got advertisers who are paying for the media. And there was talk about recession. Now they're talking about stagflation. That seems to have surfaced in discussions with some economists. So my understanding, Pete, and you've got a better understanding of economics than me, having been educated, that stagflation takes place when the economy is going through a tough time, and instead of inflation depressing the economy has stagnant growth, high unemployment and persistent inflation. It sort of seems like what we're doing. Our growth is slow. Unemployment hasn't gone up yet, but inflation is persisting a little bit. What are your thoughts about that?
I think sometimes people have got a bit too much time on their hands. I think, look, anyone who lived through the 1970s and 1980s and heard people today talking about stagflation, well, look, don't take my word for it. Let's look at market-based expectations for inflation. 10-year break-evens in the US, 2%. So inflation is not likely to stick around. In fact, we may well find over the next year or two, as supply chains come back online in full, and those higher interest rates start to bite, that actually there's a risk of inflation falling too much. So, yeah, we've definitely been through a really unusual few years because of the lockdowns and the border closures and all of the restrictions related to COVID. But I think stagflation might be just stretching the definition a little bit, and it's probably not quite so bad.
No, well, as I said when I started discussing this particular topic, the media needs to find something new, doesn't it? Now, I want to have a talk about home loans because that gives us a good leading indicator to what's ahead. But before we do, tell us about your new book, because I keep seeing on social media that it's appearing in the airports and people are standing around holding your book. How's it going and what's it about?
So it's the buy right approach to property investing. So it's that sort of light blue book if you're in the airport stores or if you're in Dimmock. So you can also buy direct from us, kateandpeteproperty.com.au or
I'll leave a link in the
Amazon.
show notes to that, Pete, because people are probably on their exercise bikes or treadmills. Not that you or I are at the moment.
So the book is, the subtitle is Mastering the Skills to Invest Wisely in Property. And Kate Bakos, who you know, has been active in the industry for a couple of decades now, and as probably more than anyone, she knows about how property works at the coalface. So we've kind of fused my top-down approach to Kate's real-world knowledge of how property markets work, and we've just tried to distill everything we know about property investing, everything from due diligence, doing your research, taking that sort of cautiously optimistic long-term view and managing risk, and just working out the returns on your investment so you can invest for effectively a property pension.
Well, there's lots of books out there and there's all the free information. So let's tease the people listening to this. Why should they buy it? What are they going to get from it?
I'm too humble being a Brit, I suppose. But as you know, Kate and I, we've got a combined level of experience now, worryingly, of about half a century. So I think you would like to think that over all that time, we must have learned something through the market cycles. You should check out our podcast as well. We've got a bonus episode coming up in the next week or so on the 7 most useful mental models for property investors, sort of inspired by Charlie Munger, who passed away recently. And yeah, it's an absolute cracking episode there, just talking about how the magic 3 ingredients for property really is leverage, compound growth, and then the magic ingredient of time. If you can sprinkle a bit of that on, then you get the sort of bagatelle or jackpot results. So yeah, it's really interesting stuff.
Fantastic. Well, I'll leave a link into the show notes to that. Now, we're talking about the economy so far. We, in these big picture podcasts, try and focus a bit on that because that gives a clue to what's ahead. But if we look at some of the latest statistics, I keep track of, as I know you do, the home lending figures, because there are 2 opposing storylines in the media at the moment. Again, talking about the media, one storyline loves to run the story that the great Australian dream is dead and the young Australians can't afford to buy homes anymore. But the other one, revealed by the latest ABS statistics, shows that, well, the data figures shows that the dream is alive and thriving. The most recent ABS statistics showed that there's a growing number of people buying homes, including first home buyers, particularly investors. In the month of July, the latest figures that came out showed that there was $30.6 billion worth of home lending approved. To me, Pete, that suggests we're buying $1 billion worth of property a day in Australia.
Well, those latest lending indicators figures were a bit of a turn up for the books, weren't they? Because I was sort of expecting things to hold up okay, but it looks like borrowers are getting in ahead of interest rate cuts. There was if you look at housing lending from a year ago, we're up 27%. So owner-occupier lending was up 3% in July to be 21% higher over the year. The real surprise was investor lending, 5% up in July and 35% over the year. Now, as you mentioned, there's an interesting subcategory to this, and that's that first home buyers. Well, there was about 10,000 loans written in July, way up from a year ago. It sort of goes against the narrative that first home buyers are being locked out because the numbers have been surprisingly robust. And again, I think this is fueled partly by government incentives and the bank of mum and dad, as we already talked about. I think the only real disappointing aspect to the numbers was that housing construction lending was, again, very disappointing and it declined further over the month. So, yeah, generally it looks like very buoyant numbers, but just construction is pretty slow.
Well, that's a challenge because we know there's a real shortage of housing to buy and to rent. And we also know the government's got these huge aspirational targets of 1.2 million homes over the next 5 years. But the latest figures from the Australian Bureau of Statistics and then the HIA and master builders all chip in as well suggest we're not getting anywhere near that, are we?
Well, no. So I think if you look at the numbers for building activity, we're running at about 40,000 dwelling starts a quarter and about the same for completions. I mean, we probably need to be about 50% higher than that. So we're way down. I do think things will start to pick up from here. House approvals in Perth are on the way up quite a lot, actually.
Yes.
Southeast Queensland is on the way up.
Victoria's building its share of homes too, aren't they?
Not too bad. I think the aspect where we're falling really short is units, apartments,
Yes, yes,
townhouses,
yes.
duplexes. I think it's just for a lot of developers, the profit just isn't really there to incentivize much development. So yes, I think for the more sort of unique property with a bit of scarcity value. So if you've got a unit block in the Gold Coast with a nice ocean view, well, that's one thing. But your average suburban unit is just not being built in Sydney. Same in Melbourne. Same in Brisbane. It's just way down on what we saw in 2015, 2016. So I think if you sort of compare that to net immigration, which even in July was still running at very high levels, yeah, we're just not building enough, is the long story short.
Having said that, both you and I, just before we press the record button, were talking about our respective businesses seeing a solid level of inquiries from investors in particular, but also home buyers. I think the current environment is giving a mixed bag of opportunities. Sure, there are risks ahead, but I think you, with your experience, ours, we know where the landmines are. But the economy has been more resilient. The labour market's being strong at the moment. And even though the per capita recession suggests that maybe we're going to have a bit of challenge, the economic gains aren't evenly distributed. Some people are suffering, but you already mentioned the bank of mum and dad. You already mentioned the fact that we've mentioned that some people are still doing very nicely, the baby boomers who've paid off their homes. So our property markets are still growing, they're not as fast, and boy, are they fragmented this year. I think that's one of the big surprises, but I think that there are opportunities. And in particular, we're seeing a lot of people very interested in Melbourne at the moment, Pete, thinking maybe it's where Brisbane and Perth were 3 years ago. The difference in Melbourne prices compared to the other cities depends whose figures you look at. We know that CoreLogic say that Adelaide, Perth, Brisbane have overtaken Melbourne, but they're talking about dwelling prices as opposed to home prices. And in Melbourne, when you combine the dwelling prices, there's lots more apartments in the mix, aren't there? So it's not really comparing apples with apples.
No, of course. I think the median house, for example, in Adelaide is pretty close to the city and pretty close to the beach, whereas Greater Melbourne, is an enormous area and it's not really comparable. As you mentioned as well, there's a lot of different types of dwelling stock as well, and much more higher density, of course, in Melbourne. So yeah, Melbourne's had a difficult time for various reasons with state debt and I think various issues with land taxes and tenant rights and so on. But these are the market cycles, I guess. I think if you were to look out over the decades ahead, Melbourne is projected to be the biggest city in Australia and the biggest population growth. So there's no shortage of long-term demand for housing. It's just a different stage in the cycle from, let's say, Perth, which is getting close to the top.
Now, interestingly, we talked about taxes. There's a new tax in Victoria that not everyone's aware of, a vacant land tax, or the vacant residual land tax, the Victorian government's calling it. So if your property is vacant for more than 6 months in the preceding calendar year, and it's land with a home on it, or even if it's being renovated, or even if your property's been demolished, for a new home to be constructed, or if it's been uninhabitable for 2 years, they've now introduced from January 25, so that's not long away, a new vacant residential land tax. The government in Victoria is trying all sorts of ways to, I guess, make up for its deficit, and they're slugging investors, but now homeowners as well. If you're renovating your home, if you pull it down to build a new home, you pay a vacant land tax, Pete.
Yes, we can't tax our way to wealth. I mean, obviously, we don't need to go over old ground, but there was a long lockdown in Victoria, and there's been a few sort of infrastructure decisions that were somewhat suboptimal. But these are the cycles as well for states. New South Wales had similar challenges not so long ago and solved them via asset sales. So yeah, they're just trying to balance the books a little bit in Victoria at the moment. The property market is pretty resilient overall. I think there's been some declines. As you always say, take the long-term view, focus on the high-quality assets and be strategic.
Definitely. Now, just before people get too scared, it's more the inner suburban areas for the vacant land tax. I'll leave a link in the show notes for the Victorian Government State Revenue Office where they talk about this land tax and what it's involved. So it's not really, interestingly, for the outer suburbs. They're taxing the richer people, maybe, Pete, they're the suburbs that don't have Labor Party candidates in them. But let's not get political about that. So maybe we should finish off by saying what you just said a moment ago. You really do have to take a long-term view. We haven't had a recession. We haven't had a mortgage cliff. Yes, we are having challenges, but the best is yet to come. This is part of the cycle. And I think that's the benefit that you bring, having been around the cycles a few times, and I bring. And it's one of the things that this new wave of property gurus on the internet, I don't think can bring to the party. While others see chaos, I think you and I can see some clarity.
Well, yes, and I think as well it's worth recapping. If you went back to the early part of 2020, the sheer level of uncertainty, we just had no real clarity on what would happen. Of course, the government put in place big stimulus packages, and a lot of people were paid to stay at home and all that kind of thing. But there was no real sort of clarity about what might happen. And if you think about all the the range of possible outcomes, we must be in the top decile. It's just been incredible. And in fact, a lot of the concern over recent times has been that the economy's been running too hot and inflation's too high. I mean, it's not a terrible problem to have when you think what might have been. So, yeah, I think, as you say, investors would just need to be discerning, maybe just look beyond the headlines a little bit and try to think independently and think strategically.
Fantastic. Well, you always bring great depth and perspective to these chats. So thanks a lot for your time today, and I look forward to catching up with you in a month. Where will you be then? Are you going to be in the United States or back in Australia by then?
I'll be in Noosa by then, so hopefully coming into a nice warm spring. So, looking forward to catching up.
Fantastic. Thanks, Pete.
Thanks.
Well, lots of information from Pete Wargent, and I hope it's giving you confidence to know that despite all the challenges, there's lots of opportunities in our housing markets. Now, if you don't currently subscribe to this on either your podcast player or on YouTube, where we play these audios as well, just stop for a second, subscribe so twice a week you get information from my guests and me. In a moment, I'm going to share my mindset message with you. But beforehand, I guess I'd like to just say, are you thinking about getting into the property market this year, either as an investor or a home buyer? If that's the case, you're probably like a lot of clients we see at Metropole, and you've got a number of questions you'd like answered. So why not go to metropole.com.au and organise an obligation-free chat with one of our wealth strategists and let them answer your questions. If you're stuck like many others are, or whether you're wondering, should you buy, should you sell, or should you just wait in the current markets, go to metropole.com.au and organise a chat to discuss your questions with a wealth strategist. By the way, we have no properties for sale, and so therefore we can give you independent advice. By the way, we also are much more than just a buyer's agent. We help our clients safely create intergenerational wealth through strategic property and wealth advice. And we're big enough to tip the scales in your favour, but still small enough to care. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to explore one of my favourite Jim Rohn quotes. I think it'll hit home for a lot of people. Jim Rohn said, everyone must choose between two pains, the pain of discipline or the pain of regret. Now, the American entrepreneur that was one of my early mentors was really great at capturing the discipline required for success. And this particular quote is really spot on. You see, there's no straight path to success. You'll need hard work and then some. But so how do you stay motivated to do whatever you have to do over many months, over many years? So I thought I'd compile a few tricks for you today to help cultivate your self-discipline. I guess it's a bit like a muscle. The more you use it, the stronger it becomes. Okay, here's a few tips. Number one, know your temptations. We're all capable of being pulled off the right path, and these temptations will be different for everybody. Look, you may be a procrastinator, easily spends hours on, Instagram, TikTok, whatever, every day. Now, if that's the case, you can download an app that limits your time on social media. There are a lot of them out there, aren't there? Maybe your temptation is junk food, or it's your big distraction. I know chocolate was mine, and I'd often have a break and go to the pantry and get some chocolate. Well, I've put steps in place to ensure I don't get exposed to it too often. I stopped buying chocolate. Well, actually not really true. Only yesterday I bought some chocolate-coated licorice, but by avoiding the temptation, by not having it in the way, in general, that's the right way to do things. You don't have to worry about saying no if you're not faced with a temptation. Okay, the second trick to help you keep up discipline in areas of your life is to automate your life. Now, you may be thinking at this stage, hey, he's wanting us to become a bit like robots. That's not what I'm saying at all. But the more behaviours that you can make automatic, the less you'll be relying on your willpower. Oh, let's take going to the gym, for example, because I know a lot of my listeners struggle to keep exercising regularly. So the best way to stay motivated is to work it into your daily routine and set an alarm for when you need to stop work and go to the gym. Now, don't think about what you'll do or not do at the gym. Don't ask yourself if you're going to enjoy it. Just go. I have a routine every morning to go for a long walk down the beach with my dog Lincoln. You can also take the same approach with your work routine. Now, I know for many people emails are the biggest part of the workday, so develop a system for dealing with them and stick to it. For example, you may choose to clear your emails out in the morning or maybe around lunchtime, maybe again in the afternoon. But have a discipline. If you need to have a sort of out of message office, whatever it's called, saying that I only check my emails 3 times a day. And at other times, just close down your emails. Minimize distractions. Again, as we talk about a couple of ways of you can learn to be disciplined, because remember, Jim Rohn said there's either the pain of discipline or the pain of regret. The third way is to introduce rewards. Look, humans are hardwired to seek rewards for their efforts. That's why if no one's rewarding you for a particularly tough accomplishment, hey, you need to step in and reward yourself. In fact, you know better than anyone else what your weaknesses are. So whenever you've achieved a self-discipline milestone, make sure you reward yourself with something you really enjoy. Look, it could be a drop of red wine, a new set of golf clubs. It could be something big, something small. It doesn't matter. But this way your brain will start to associate self-discipline with pleasure. Well, eventually, and it will become a great incentive to stay on track. And the fourth way I'm suggesting, the fourth tip I've got is to get back on the saddle, because there will be times when you let yourself down and your self-discipline fails you. Hey, that's okay. It happens. But make sure you get back on the saddle. A lot of people use this experience as an excuse to fall back into bad habits. They throw the baby out with the bathwater and make generalizations about their abilities. Oh, I'm not good enough to be successful. Oh, the system is rigged. The only thing to think when you stray from the discipline path is, how do I find it again? Don't waste time and energy beating yourself up, and don't throw the towel in, because if you don't eventually get back on the discipline path, you're going to look back at your life and realize you've wasted a lot of time. Now, that would be a terrible state to be in. So back to Jim Rohn's quote that I mentioned right at the beginning. Everyone must choose one of 2 pains, the pain of discipline or the pain of regret. Which are you going to choose? Thank you for spending the last little while with me. I hope you got some benefit from this show. Hey, but before you move on to the next podcast you're hoping to listen to, please let me remind you that I have another show that I produce once a week with leading demographer Simon Kirstenmacher that we call Demographics Decoded, where we unveil the trends that are going to shape your future. This is a must-listen-to podcast for anyone interested in property investment, business or entrepreneurship. So if you don't currently subscribe to Demographics Decoded, please stop for a second, subscribe on your favourite podcast app or on YouTube. Now, if you did enjoy today's show and you know somebody else who'd benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just talk to them, tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour. You're definitely going to be doing me a favour in helping in my quest to make as many people as possible financially literate. Now, you can catch up with me in between these shows on social media or you can join my private Facebook group. Just go to Facebook and look for the Property Update Facebook group. And I've got a special bonus for you to say thank you for subscribing. Just go to podcastbonus.com.au. There's a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. That's my way of saying thank you to you for taking the time to listen. Oh, by the way, if you haven't listened to the many podcast episodes we've already got, we're well into our 600s of episodes now. You can always listen to the old episodes, which each have lessons about property investment, success and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?